What's up everybody, this is Yasin and you're watching The Passionate Realtor. In this video, we're going to cover a lot in terms of what came out last week. We got Stats Canada came out with the negative GDP growth in Q2. We got Bank of Canada came out to announce that they're going to continue the 0.25 base interest rate, continue the asset purchase program to inject the $2 billion per week money into the economy. So we're going to talk about that. What does it mean for you and I, a common Canadian? Let's dive into it. So a lot happened last week. So we got Canadian economic data came out last week, and according to Stats Canada, the economy shrunk 1.1% against the expectation in Q2. The economist predicted that it's gonna grow, around 2% plus in Q2, but it actually went against their expectation. I think what happened was when you see your chief economist is kind of predicting something and the real result, came out completely opposite. That means they are missing a lot of things in terms of predicting the economy. Why I'm saying that? Because right now we are living in very strange times, right? If you are predicting economy based upon your historical, data, then you are basically missing a lot. Like look around how many, commercial offices are still empty. If you drive around Toronto downtown core area, you will see a huge vacancy rate in terms of the offices. And companies are trying to bring their employees back to the offices. But the truth is the employees or workers are not willing to go back. And it has obvious reasons. Technology has shown that the work can be done remotely and effectively without commuting, hour and a half distance each way to get to the office just to do work. But it has some implications in terms of the economy. So when you look into the downtown core area where we have commercial office buildings, a lot of businesses were set up or have been set up over the years to support that, commercial real estate and the businesses, and those businesses were depending upon the commuters. So imagine if those commuters were not going to commute into the office, what will happen to the businesses like coffee shops and restaurants and other amenities that were built around those, downtown core area. So those businesses will actually go bankrupt or perhaps have already been bankrupt in the last year or so. But the total dynamics in terms of economy is completely changed. So I think the economist needs to kind of look ahead and predict based upon the new norm in terms of how the businesses are going to survive in these challenging times. The other thing came out was the Bank of Canada's announcement in terms of keeping the overnight rate to 0.25 and also continue bond purchase program in order to inject $2 billion. Basically, in simple words, they will continue printing money at a rate of $2 billion per week in order to support the government spending. Now, what does it mean to you and I as a common person? It means the inflation that we are seeing, which means rising consumer and goods prices, will continue to happen. Of course, the inflation figures that came out from government is based upon CPI, which I think everybody knows it's heavily manipulated parameter. A lot of people question in terms of how effective those calculations are, because if you look around yourself, you can easily see how much prices have gone up since last year across the board, whether this is edible items, common daily necessities, or real estate, or fuel prices, or lumber or steel. Any construction work, if you want to get it done, it's going to cost more than what you used to pay before in 2019. So inflation is not a hidden thing anymore, like people can easily spot that. But seeing what government is trying to show, it's not really a fair number in my opinion. For a common person like you and I, we will continue to see the inflation go up. Now, interest rate will have to go up at some point. What will happen? Just understand that. So when Bank of Canada announced that they're gonna increase the interest rate from 0.25 to let's say 0.5 or 75 or 1 and above over the period, what will happen? Let alone the household for now. The government of Canada has taken huge amount of loan in the last 2 years compared to what they have accumulated over the history. There is a huge difference in terms of how much loan they have taken in the last 2 years compared to the previous history. So imagine when the overnight rate goes up, how much money is going to be spent to service the debt the government has taken. They will run into risking themselves to go bankrupt. right? If they're not able to meet up debt servicing cost with the higher interest rate, they have to either increase their revenue in order to afford the debt servicing ratio, or they go into austerity measures like reducing the spending, increasing the taxes, which is of course nobody wants. So for government, it is a big challenge in terms of how are they going to cope with the higher interest rate, with the huge debt burden sitting on their head. Now, of course, household will also have a lot of impact, right? So the household who have stretched themselves in terms of over leveraging and buying 2, 3, 4, 5 properties, and if those properties are not producing positive cash flow, if the interest rate goes up, they will be in the trouble where they will not be able to cover their interest payment going forward. I'm assuming they are on variable interest rate right now, because the fixed rate is around 2.3, 2.4. Variable is somewhere around 1.3 or 1.4 depending upon your lender. So understand the impact. When the interest rate goes up on the household side, you will see a lot of insolvencies, because if the people have overstretched themselves, they won't be able to keep up their payments. On the government side, they will risk themselves into not be able to service their debt, and then perhaps go into the sovereign default condition. I think what will happen is, even if they increase the interest rate, what will happen is they will try to keep the real interest rate negative. What does it mean by negative interest rate? So imagine you have overnight rate as 0.25 and you have inflation running at 3.7%. In order to calculate real interest rate, you actually subtract the inflation rate from the overnight rate. So basically, based upon 3.7% inflation and 0.25 interest rate, you're basically having 3.45 negative interest rate. And what the government will do is basically they will try to keep the real interest rate negative, so that they will continue to afford their debt servicing payment going forward, even if the rate goes up, which means they will continue to let inflation even go further higher in order to keep the negative interest rate affordable for them to pay their interest payment. So that could also happen, or the other option is bank just keep the rate like this, and for years to come, until such time when the economy will start outperforming. And for an economy to outperform in these conditions is very hard. We have seen that how many hundreds of jobs in Canada are going unfulfilled. The companies are trying to bring employees back into the offices, but the employees are not willing to go back to the offices or do not want to work anymore. So in these conditions, how would you expect the economy to outperform? And with regards to housing, every single political leader has a plan about housing. And they are talking about raising, foreign buyer taxes, banning foreign buyer completely, or giving first-time home buyers some incentives with regards to CMHC programs. But nobody is talking about the financial system that has a huge impact on the housing. I have been talking about in my videos. You consider lowest interest rate. You consider that there is no other option to save your money in. For example, all these savings accounts like GICs or TFSA, like how much interest they are yielding you today? Less than 1%, hardly. So in these conditions, why people will keep their cash into these saving instruments where they're not getting interest on their payments anymore. So they are incentivized, or they are pushed towards spending money into buying real estate assets, because this is the environment that the central bank and the government fiscal policies and monetary policies have created. So we cannot blame those investors, or we cannot blame people who are leveraging themselves, over leveraging themselves and buying real estate assets just to protect their cash, because their cash is getting devalued and they have no other option to put their money into something that is going to hold the buying power, let alone the appreciation. So in these conditions where the policies and the environment is actually built to incentivize the investors to pump money into real estate, we cannot blame any foreign investor here. So all of these political leaders are trying to, fixing things here and there with little tools, but nobody's basically pointing the main issue here, which is the financial system that we live in It's a debt-driven financial system. As you slow down the debt towards housing, mortgage debt, you see the GDP actually declines along with it. So that's the main problem that nobody wants to talk about. That's it from me this time. I hope this is helpful. If you like it, give me a thumbs up and hit subscribe. And I will see you in my next video. Take care.